Hillary, why don't we start with you and lay out the case for stocks right now in a difficult time, perhaps, to make that argument. The New York Times editorial yesterday that investors are abandoning stocks, aren't they?
Well, investors have been abandoning stocks, and we know that from low volumes, and have been buying treasuries. But first, I would just like to say good morning. It is such a pleasure to be here. Everyone who has ever followed me knows that I have been a perennial bull. And the way to make money in this country, in this market, is to identify companies or a larger segment, industry, and invest there. We have innovation. We have on Friday, even if it's hyped up, even if it's at a higher valuation than it should, we have Facebook coming public. We have companies like Splunk, Toomey, that have come public in the past month. We have the ability in our country, in comparison to any other, the United States has the best transparency, gap reporting, the ability to create wealth amongst investors. Now, are volumes declining? Yes, the reason volumes have declined is simply that there is less of an emphasis on the concept of day trading, and to a great extent that's been replaced with individual investors investing in areas like options, discovering other ways to make money. I am a bull. To go and buy gold in this market doesn't make any sense. You know, we might have a treasury bubble where treasury prices are high and yields are low, but if you look historically, we had one for 30 years that went on, that spanned World War II all the way up until the 60s, and it was only when we went into a wartime economy did we see rates start to rise. Don't think that the United States is going through some period where our strength, innovation, creativity, and ability to be a leader is falling. China is a disaster. They have entire cities that have been built that no one's living in. They started a train system that had 2 million employees to build out the trains across China. They literally said, we don't have the money, we're done, fired them all, didn't even bring the people back in. You know, everyone talks about China and Jimmy Rogers, the great motorcycle trader, as we know, the commodity investor, deciding to live in China. He didn't last there more than 3 months. He lives in Singapore as a proxy for China. The Chinese want to make their money and get here to the United States. That's where everyone wants to come, is here to this country. Now, one other important point specifically, and that's that when you take a look at our actual market and you take a look at PEs, we're trading at a very reasonable, historically lower PE in the 13 to 14 range. We have 579 of 2,000 largest cap companies have a yield of 3% or more. Right now, we all need yield. We all want to see some income coming in. There's no question, even those of us like myself who are ordinarily growth stock followers, and those like me that look for the small caps, I'm out there looking for yield. But guess what? I'm finding it. And I'm finding it with companies that are still growing. And you can get it. 3M with 2.7% yield. Honeywell, 2.5%. DuPont, 3.3%. Walmart, 2.7%. Take a look at so many of the companies and the opportunities. And let me tell you, the most important important thing to know about treasuries and to not be afraid of this bond bubble that's going to break. The Chinese don't buy our bonds because they're our friends, and one day they're going to say we don't want to be their friends. They need to make sure that their currency stays cheap, so we'll buy from them. The minute it doesn't, it's going to be fine. We're going to start manufacturing here, and we're already seeing that. So have faith. There's a lot of money to be made in the market. There's trillions of dollars on the sidelines, and equities are just waiting for the opportunity to head to the upside after a really, really lean 12 years that has been very disappointing. We're going to see some real upside.
Very good. Well, Peter, Peter,
well,
you know, she makes a good point. There's and earnings are rising. They have been rising, haven't they?
I don't know. I don't even know where to begin. Maybe I could begin with the comments about Facebook in America being such a great place that the co-founder of Facebook decided to renounce his citizenship and move over to Singapore and join Jimmy Rogers. So, but, you know, Hillary is talking about being a bull, and, you know, she has to acknowledge, though, that she's been a bull. She's been wrong for 12 years. The bull market ended in 2000. In 2000, the Dow Jones was worth more than 40 ounces of gold. Today, it's only worth 8 ounces of gold. This is a historic bear market in U.S. stocks. Now, maybe Hillary thinks that the bear market has ended and that a new bull market has begun. I think that's very doubtful. I don't think the trend is anywhere near complete. I think over the past 12 years, a lot of people have tried to call the bottom in the stock market, and they've been wrong. And I think that people who are calling the bottom today are wrong. But it's important to keep in perspective, when you value stocks, you have to value them in gold. You can't value them in dollars, because the bear market in the dollar is even bigger than the bear market in stocks. And so, yes, investors will lose less wealth, less purchasing power owning stocks than they will owning cash. And I would concede that point. I am not thinking that the stock market is going to collapse. Rather, I think the dollar will collapse, and I don't think stocks will rise enough in general to make up for that loss. Some stocks might, but overall the U.S. stock market will not, because contrary to Hillary's characterization, our economy is a complete disaster. I mean, anybody who thinks that the financial crisis or the economic crisis is over didn't understand the problem in the first place. And in fact, when I wrote my first book, Crash Proof, that came out in February of 2007, the crash that I was forecasting is the one that's about to happen, not the one that already happened. Yes, I did say or write in that book that we were going to have a collapse in the housing market. I did say we had a bubble in houses, and that when housing prices collapsed, we would have the worst recession since the Great Depression. I said that we would have double-digit unemployment. I said that we would have trillion-dollar deficits. I predicted that Fannie and Freddie would go bankrupt and that many banks would fail. All this stuff I wrote. But that was not the crash I was worried about. The crash I was worried about was the one we were going to get as a result of all the stupid things the government was going to do as a result of the first stuff that happened. And so all the bailouts and the stimulus and the quantitative easing and the 0% interest rates, that was what I thought would bring on the ultimate collapse. And right now, the only thing really that stands between the U.S. economy and collapse are countries like China that are giving us the rope that we're hanging ourselves with, that are lending us all this money, despite the fact that we have no possibility of ever repaying it. I think right now you also have people who are jumping to the wrong conclusion that Europe is in worse shape than America. It's not. We're in worse shape than Europe, but the dollar is still perceived, I think, wrongly as a safe haven, and so we temporarily benefit from the fact that people are worried about the euro and are jumping out of the frying pan into the fire. They just haven't felt the heat yet. But our economy right now is a disaster about to happen. There is no economic recovery underway. All that we've done is borrow trillions of dollars and spent it. We have a bubble in the U.S. government. We have a bubble in the bond market. The bubble is going to prick. The Federal Reserve understands this. The Federal Reserve knows the only thing preventing this phony recovery from imploding is 0% interest rates. That is why the Fed has not raised rates. If there really was a recovery, the Fed would not keep interest rates at zero. The problem is, when interest rates rise, the U.S. economy cannot afford it. The U.S. government cannot afford to service the debt. If interest rates rise to a normal level, the only thing we could do would be default. All of the banks, the major banks, Bank of America, Citigroup, J.P. Morgan, Morgan Stanley, if interest rates rise to appropriate levels, these banks will fail. The Federal Reserve knows this. That's the reason that when we did the stress tests, the Federal Reserve did not ask the banks to stress test the bursting of the bond market bubble. They only asked the banks to consider the impact of falling stock prices and falling real estate prices. But the Fed can stop these prices from falling if it prints enough money. But it can't stop the bond market from collapsing. It can't stop the dollar from collapsing. And that is what we are headed for. We are headed for a sovereign debt currency crisis in this country. The reason the American economy is so screwed up is because the Federal Reserve has kept interest rates for too low for too long. It's done this for political reasons. It's inflated this gigantic bubble. Interest rates are probably the most important price in a market economy. They need to be set in the market, not by the government. But unfortunately, in America, the price of money is determined the same way the Soviet Union used to determine the price of bread. Bureaucrats just pick it, and the rate is too low. And because interest rates are too low, we haven't saved enough, we haven't produced enough, we've borrowed too much, we've consumed too much. The world has supported this consumption. They've enabled us to live beyond our means, but our ability to continue to do that is rapidly deteriorating. And Hillary mentioned that, hey, if the Chinese stop selling us stuff, well, we'll just build factories and make the stuff ourselves. How are we going to do it? Where are we going to get the capital? In fact, we can't even find the workers to hire for the few factories that we have because our young people were wasting government money getting liberal arts degrees instead of learning how to make anything.
Thank you, Peter Schiff. Well, Hillary, can't we have Christmas first? It sounds like we're doomed, isn't it?
Oh, not only are we not doomed, it's just moments like this that we're just about on the cusp of entering a great bull market and opportunity to make money and to see prosperity. In terms of our country and where the jobs are, it's very interesting. I went with the president of Kia Motors, the Korean car maker, down to a little section of Georgia that used to be known for its mills. What they've done there is they've hired over 15,000 employees, invested over $2 billion. They've just rolled their 500th car off the line. There are less than 100 Koreans that work at that factory. There are suppliers that have opened up. The entire area has now attracted restaurants, hotels, two universities, opened up campuses there. This is what we're starting to see. We're starting to see in Detroit, finally, signs of life, an economy that's improving. There's a little bank, CRBC. The stock has doubled in the past year. It's the largest bank in Michigan. There are jobs coming back. Yes, it's a recovery without the kind of jobs and the quantity that we need. But still, 85% of those who want to be working are still working. And when it comes to a bond bubble, I have to go back to that for a minute. Julian Robertson, who was a great investor with Tiger Management, in 1997, Julian Robertson said, "Those internet stocks are ridiculous. They are overvalued, makes no sense. I'm gonna go for real hardcore sectors like transportation," and he bought U.S. airline stock, and then he shorted all these internet stocks. He shorted so many that he lost billions of dollars of his investors' money. By the time that the internet bubble did burst, the investors had lost everything, and the investors were gone, and his fund was closed down. Now, he personally made some money because he held on to some of those shorts, but the key is it takes time for cycles to play themselves out. Even in terms of housing, if you look, we're finally scraping along the bottom. That jam up on foreclosures, it's finally working its way through. We're seeing housing starts and those numbers coming back. We will see some signs of life in that area because obviously that was the central theme and the real core problem that then became an entire meltdown and freeze in our global market system. And as far as Europe is concerned, and Peter's point about Europe being healthier or stronger than us, we have this federal system of 50 states. So if we have a state that gets into trouble, and let me remind you, municipals had a great year. Okay, municipal bonds did fine this year. But if we have a state that gets into trouble, our Constitution, the way Washington is designed, we can still stand as a country. What Europe has done, the Europeans have tried to take the best of both worlds. They've tried to stay autonomous, but yet form together in a group really for purposes of trade. And what they've done is they've created such a logjam and a cultural albatross that the only way they're going to get out of it is by these defaults. First, Greece, you're going to see it's going to go back to the drachma. Spain default, Portugal, Ireland, the entire EU structure is unwinding. If you want to talk about treasuries, the 10-year in Germany, yesterday I saw it down around 1.46%. And what do you think all that happened there? The reason everyone's there's such trouble and there can't seem to be any resolution is that Germany lent the money to Greece for Greece to buy from Germany rail lines and port equipment and aerospace, engineering equipment, build new electric plants and natural gas powered, and they built it with money that was borrowed from the Germans that now the Greeks can't pay back. Italy is in trouble. Europe is in serious trouble. That's why we have a flight to quality and safety here in the United States. Why do you think we have companies here that are hitting up against their 52-week highs? Why does everybody want to buy here a utility or a diversified consumer packaging company? Even our pharmaceutical companies are coming back. There is wealth to be made in this country. And one other point that Peter made, which is that, I've been this bull and there's all this money that's just been lost. I've made a lot of money. That's why I can sit here today.
You've made a lot of paper. Measure it in gold.
I've made a lot of money that I've been able to take.
Would you have made more money if you just held gold?
No,
for the last 12 years.
I would not.
You've outperformed the market that much?
I have outperformed the market.
I'd like to see that you've outperformed the price of gold for the last 10 years.
And I can show you, and I can give you let me give you the kind of example of the way that I made money. You take a stock like NASDAQ. Okay, this is innovation. This is
Don't
this
pick
country.
one stock.
Okay, I'll pick 20.
No, but
How
you
much
pick the
time
whole
do we
market.
have?
We're talking about the market.
But you got to start on the granular. The granular builds to the total amount. You have to look at the individual to be able to add it all up. Okay, so take a stock like NASDAQ. It traded on the pink sheets, NDAQ. Yeah, I bought about $500,000 of NDAQ at $4 a share. I saw what NASDAQ was doing, transforming themselves, becoming an electronic exchange, going into a new century and a new time to compete against the New York Stock Exchange. I recognized it. By the time I sold my $4 stock, NDAQ was trading on the NASDAQ where it belonged and was a $45 stock.
So you had everything in that one stock?
No, it was
All
about
right,
1%
well, that's my
of my
point.
portfolio.
My point is that I doubt that your performance has matched the performance of gold. If I'm wrong, show it to me. But anyway, let me go and address a lot of the points that you made. I mean, first of all, if you're going to try to say that we shouldn't worry about the bond bubble because Julian Roberts was early in predicting the stock market bubble, he was right. The fact that he was early didn't mean he was wrong. Now, if you want to say...
But all those people lost all their money.
Well, I don't know how much money those people lost, but
Billions.
internet stocks, 90% of them went to zero. People made a fortune shorting those stocks. But I agree, people lost money shorting them early who covered. Same thing with real estate. Look, a lot of people made money in real estate on paper, and then the market collapsed. And, so some people were early and wrong, but because they didn't have the staying power. But to say that the bubble wasn't there because some people recognized it early, the bond bubble has been going on for years. Yeah, plenty of people have made money shorting bonds over the past 20 years. But to say that, well, it's going to go on for years and years more and we don't have to worry about it, it is the biggest bubble there, and we have to worry about it because without the ability to borrow cheap, this economy implodes. It is completely addicted to cheap money. We are more indebted now than we've ever been in history, and we're less able to pay it. The only reason we can keep it going is because rates are at zero. If they moved anywhere up, and even a little bit, the whole thing would implode. But it's interesting when you point to the problems of Europe, and you look at Greece, and you look at Germany, yet you don't see the similarities between America and China. China is our Germany. We're Greece in this relationship. We borrow all this money from China and consume. We just buy products. We spend it on government. We spend it on consumption. We owe the Chinese over $2 trillion. And, they're sitting on over $3 trillion in foreign exchange assets. America is the world's largest debtor nation. Our trade deficit has gone through the roof. Last month, Americans borrowed more money in 1 month than they have in any month in 10 years. Consumption is at a higher point of our GDP than it's ever been. Talking about what's happening in the economy, we're supposedly 3 years into a recovery, yet better than 8% of the Americans are unemployed. And the only reason it's 8% is because a record number of Americans have left the labor force. We have the smallest labor force since probably the 1950s. We have record numbers of Americans who are now on disability because they couldn't find jobs. But I think if you look at the real unemployment rate, it's probably at least 15% when you count a lot of people who are working part-time. If you look at the anecdotal evidence, California just reported a much larger than expected budget deficit. Their tax revenues are lower today than they were a year ago. That's the largest state in the U.S. economy, and their tax revenues are falling 3 years into an economic recovery. The only thing, as I said, that's keeping this going is that we can spend more borrowed money. But if you look at our anemic GDP growth, which I don't even believe is real because I think the government is underreporting inflation. And so I think by doing that, they make it look like the economy is expanding when it's actually contracting. But even if you buy the government's numbers and you assume that our GDP is growing by 2% or so a year, our debt is growing by substantially more than that. So we are not growing the economy. We are spending ourselves into bankruptcy. If it was a corporation, right, you're looking at the assets, but the liabilities are growing at a much faster rate than the assets. And it's the exact same situation that we had with the housing bubble. And I remember talking to a lot of people who had a similar idea that you have on the housing market. Don't worry about it. Don't worry about all the mortgage debt because we have all this home equity. Real estate prices are never going to fall. They always go up, so I don't know what you're talking about. I had to point out that real estate prices don't always go up. They can fall, especially when they reach bubble levels like the levels that we had. But the problem was, even if real estate prices came down, the mortgages weren't going to go away. The debt was real. The equity was an illusion. And so the U.S. economy is an illusion. We are spending borrowed money, but there is a limit to how much the world is going to lend us because the world is going to figure out, just like they figured out with Greece, we cannot pay the money back. We are not good for these debts. And, just pretending that we have a legitimate economy by spending money. You mentioned some of the yields that there are in U.S. stocks, 2%, 3%. That's not even the rate of inflation. I mean, we need U.S. stocks to yield 8%, 10%. That would be a good deal. But yielding 2 or 3% in the inflationary environment we have now, that doesn't sound very cheap to me.
Peter, I have to talk about gold here. We've had a rough market the last few weeks. The price of gold dropped. You would have lost money owning gold. Gold, the idea of gold should be just like any asset class, a small percentage or a diversified percentage of your portfolio. Gold should not be considered some kind of hedge against risk. It doesn't work that way. Gold doesn't have the value it once did 500 or 600 years ago when we had one common currency.
What are you kidding? The only thing gold is money. That's what it is. It's not an asset. It's not a risk on, risk off. It is money. And if you want to look,
gold is losing investors' money. And
no,
investors were convinced to buy gold just as the hedge fund and the smart, fast money was selling. You were the fools because you listened to this idea that you needed to be buying gold after it had already appreciated. Again, the key is to be diversified and even diversified into real estate markets.
All right. I just got to.
But in terms of our country, Peter, why do you live in Greenwich, Connecticut? Why don't you move to China if it's so great?
All right. Well, before I address
there are a lot of Chinese who'd love your house.
Look, let me explain a little bit about money to you and about gold. Okay, if you go back in 1913. Right? The Federal Reserve was created. Since then, the dollar has lost 98% of its value relative to gold. So if in 1913, if you buried an ounce of gold in the ground, or if you buried $20 in the ground, right, and you dig it up today, you can buy the ounce of gold can buy $1,600 worth of stuff, and the $20 can just buy $20. Gold has maintained its value not just for 100 years, but for thousands of years. When you're looking at gold, you don't compare it to stocks. You don't compare it to real estate. You compare gold to dollar bills. You can compare it to the euro. You can compare it to the yen. You compare it to fiat currency. And I can tell you for thousands of years, every fiat currency has collapsed to zero. There isn't one historical example of paper money that has ever survived, but gold has always survived. Okay. And if you're going to say, gee, somebody's lost money if they bought gold 2 months ago and sold it yesterday, well, who's dumb enough to do that? And who's ever recommended that? All I've told people for the last 10 years is buy your gold and hold on to it. And if you did that, you have a lot more money today than people who held on to stocks or kept their money in cash or CDs. And the reason I think that is because I still think that stocks in general are expensive. Doesn't mean I think that you should always only own gold, because I think there are times when you can invest your money in the stock market. But if you don't want to invest, if you want to stay liquid, if you want to be in money and not assets, then why would you want to own dollars, which are going to be run off the printing press in record numbers, when you can own something scarce, something with intrinsic value like gold?
Okay, now let me just... Good points, Peter.
Yeah.
Fascinating answer. Unfortunately, it's not the question. The question is...
I didn't even know there was a question.
Yeah, the question is the stock market bearish or bullish over the next 12 months? So what's your forecast for what the Dow Jones Industrial Average will be 12 months from today?
Well, that smart I'm not. But I don't think that the Dow is going to go much higher. I don't think it's going to collapse either, because I think the Fed is there with QE in order to put a floor beneath asset prices. But I do believe that this recent correction in gold is nearing an end. I don't know how much lower it might go. I think gold stocks right now, and I've been buying gold stocks for 10, 11 years, and I can tell you some of the stocks have had such a big drop in the last 6 months. There are gold stocks right now that are trading at the same price they were when gold was at 400. So I think there is a lot of value there. But I don't think the U.S. stock market is going to run away, but I think the greater risk is not being in stocks, but being in cash or being in bonds. I think that's where the real risk is, and I think people need to be very cognizant that inflation is a big, big threat, and people need to find a way to protect themselves. Whether that
and you're a dollar bear. You're a dollar bear.
I'm an extreme dollar bear. I think the dollar is going to lose a tremendous amount of value.
Which is a position you've been for a long time.
Correct.
But the question for the stock market that I'd like both of you to address in the minutes remaining is, are we, even if it's a tepid cyclical recovery in the economy, and are the increased earnings that we're seeing in the S&P, which is expected to be somewhere around $110 for the S&P 500, and gaining, does that tell us empirically and proving to us that we are seeing some sort of a sustainable rally, albeit nowhere near as strong as previous economic recoveries? And even in the event that Peter is correct, and we finally, because there have been more false bottoms called, to paraphrase our dear late friend Louis Rukeyser, there have been more false bottoms called in interest rates than in Playboy magazine. But if we are seeing a bottom in interest rates somewhere in here, the point that was made by Sam Stovall is that interest rates can rise, and they can continue to rise, and it probably causes stocks to actually rise, and it's a misunderstood fact until they get to about 6%, which is a long ways from where we are today.
Yeah, well,
so the question on the table is, is there a good case for the stock market to rise in this election year, or should we stay out of stocks, regardless of where we put it? Because that's kind of a different question.
I am a bull when it comes to the market, and I've been buying stocks, and I've been buying across different sectors. Now, stocks go in cycles. Apple is yesterday's stock. But hey, let me remind everyone, if you invested in Apple, triple, quadruple your money. Invested in a Priceline. But there's new stocks that you can look at. There's old world stocks that are coming back. You have companies like eBay that has PayPal. The whole concept of electronic payments is catching on all over the world. I encourage you, look at the SEC filings for eBay and read what PayPal is doing globally, going around and putting in systems so that we are actually going towards being a cashless society. Look at other companies. There are opportunities in the financials, maybe not right now, and I know that it's hurt a lot of us who took the chance and maybe said that Goldman Sachs and Morgan Stanley were undervalued and trading way below book. But at some point, the financials will come back. They don't have the same level of competition that they once did. There's mergers and acquisitions in the pipeline coming. There's a pipeline of equity transactions, as well as there's always new areas for development and for growth. As far as I'm concerned, this is an excellent year and time to invest in the market. And even if we see our currency start to fall, well then again, we'll just start manufacturing here. It's okay. We still have the country that is turned to and seen as the safest in the world, and our products are seen throughout the world globally and continue to expand. Whether it's a company like Ford or Starbucks or even McDonald's at $90 right now, McDonald's could easily become a $105 or $110 stock.
Anyway, all right.
Yeah, we're going to ask each to wrap with three investments to capture where they believe. Obviously, you're not going to buy U.S. stocks.
Yeah. Well, first of all, look, just a falling currency doesn't mean we can automatically just start to manufacture, because the falling currency is going to drive up raw material costs, imported components, interest rates. It's not a good thing. Also, want to make a quick statement on corporate earnings. They are a function of cheap money. When interest rates rise, U.S. corporations are highly levered. They have a lot of short-term debt. That's going to bring up their own interest costs. Their customers, of course, won't be able to buy as much of their products if they can't get financing. So this whole thing is a bubble built on cheap money. The cheap money goes away. Stock valuations are going to come under a lot of pressure. I don't know how much of that pressure will bear between now and the election. They're going to try to prop things up. But if you want to be in the stock market, if you want to own stocks, I agree for the long run, if you get quality stocks, if you buy value, you get good dividends, I think it's a great place to invest. Just not here. I think you're much better off looking around the world, investing in some of the more emerging markets, Southeast Asia. Invest in the countries that are doing it right, at least more so than we are. Countries that have less government, that have trade surpluses, that have young, vibrant, working populations. Look at the countries that are accumulating surpluses, not deficits, the countries that are accumulating enormous foreign exchange reserves. They have tremendous gains to be had when they stop buying dollars and stop buying treasuries and start investing their surpluses in their own economies and allowing the appreciation of their own currencies to benefit their own consumers instead of taxing their own consumers to subsidize Americans. So I think you can buy stocks around the world. As I said earlier, I think gold stocks are incredibly cheap right now. That doesn't mean that they can't get cheaper, but I think they can go a lot higher. Excuse me?
That's one investment idea?
So gold stocks, foreign stocks with good dividends, is another investment idea. And, if you want a little bit less risk, you can buy shorter-term sovereign debt or corporate debt in countries like Australia, Singapore, Norway, New Zealand. There are some other countries, if you want to clip coupons, there are some higher-yielding currencies that will rise against the dollar. And, again, I think gold's headed a lot higher. And I think the bear market in U.S. stocks will continue. At one point, I said the Dow was worth 40 ounces of gold. Now it's worth 8. One day before this bear market ends, I think the ratio will be very close to 1-to-1, at which point U.S. stocks will probably be a good buy.
Thank you, Peter. Do you have three stocks and a conclusion remark?
Yes, I do. There are a number of companies that have very nice, very appealing valuations, and you can get that yield today. Waste Management, WMI, Waste Management, 4.2% dividend yield, trading at only 13 times earnings, and is the leader in waste management. An ag company, DuPont, as agriculture becomes stronger and more important, seeds, fertilizers. DuPont has a 3.3% dividend yield. It's only trading at 10.6 times earnings. Another way that you can play the market, I think that in Europe you have companies that have come down considerably and you have some value there. The Vodafone in particular, the UK-based telephone company is one of the best managed companies in the world. The ticker symbol is VOD. Vodafone knows how to operate in countries all over the world, and you have a 5.33% dividend yield. We're going to hear a lot about Vodafone with the Olympics, their sponsorship. That's a great way to diversify and to buy into Europe, as well as other companies in Europe that should see some recovery that are really global plays, including with operations here.
Any other conclusion remark about the market itself?
Yes, you want to buy stocks, you want to buy equities, you want to be diversified. Have a mix in your portfolio. It's the safest way to invest. And don't invest looking in the rearview mirror. Look forward for the new opportunities. They're right in front of you, and that's the beauty of investing today. The curtain is down on old Wall Street that used to have all the secrets. Now that we have the internet, now that there's transparency, you have the answers faster, quicker, and sooner than Wall Street does.
Yeah. Well, I agree with much of what you just said, if you take it in that context. But also, I want to remind everybody that at 10 o'clock, I am having a workshop here in which I will discuss in more detail the types of investments that you need to make to survive the financial crisis that is coming. And it'll be here soon. If it's not a year, 2 or 3 tops. So if we keep doing these for a couple of years, we'll live through it.
Show of hands real quick, ladies and gentlemen. How many believe the market will be up at least 5% 12 months from today? Okay. How many believe the market will be down at least 5%? So it is still a slightly bullish crowd. It looks like 60.
Optimism reigns.
Yeah. Good. Well,
very good.
That's
Well,
the
ladies-
American
But
way.
Gentlemen, I
But the
wanna-
contrarians usually win, so.
Yeah, that's true. The contrarians usually
In the
win.
long run,
I
they
want to
prevail.
thank these two debaters. Great job. What's that?